Now looking at the market at this stage, losing a bit of steam, would you say?
Yes, I think it was expected by the market. If you'll notice, quite a bit of local investors back off what was happening in the European market. Most of there's usually a lag of about one week, 7 days to about 10 days before we feel the effect on our local market. And considering our local market, about 60% of it at the moment is actually controlled by foreign investors. So, I mean, it was a definite that we'd see the effect felt on our market. Also, there's some stocks that have closed their books, such as KCB, which had really caused a rally over the past, I'd say, about 2 weeks. It had rallied all the way to almost 25. It was at about 24.75. So this closed its books yesterday. Of course, the price also repriced accordingly to the dividend they were paying out to about 22 shillings. So we've also seen local investors also trying to exit these positions. But I think mostly you'd blame the slowdown in activity from as the effect was an effect from what's happening in the European Union.
Like you say, the effect of what's happening in the European Union having an effect on the Kenyan markets, that looks like it's not going to change anytime soon. So what's likely to drive the Kenyan markets going forward, ex-foreign investors?
Basically, what happens, and we've seen this cycle quite a bit over the past 2 years, where we've had a lot of issues in the West, is that whenever there's any big announcement or any big move in the European market or in the United States, we'll see the risk averseness rise somewhat, and if foreign investors will stay off. Probably for a short bit of time, but as the information they've received sinks in, they'll slowly come stream back into the market. So I don't think the current situation will hold. The market is almost breaking the 3,800 mark. I think a lot of investors are hoping to see the index break this mark, so they will be back pretty soon.
Now let's talk a bit on that 5-year auction that was held today. What kind of expectations are you placing there? We have seen yields come off quite a bit over the past few sessions.
Yeah, that's quite true. If you look at, for example, the 5-year currently on the official market yield released by the Nairobi Securities Exchange is at about 14.9%. But the market is talking about levels of between 11 to 12%. We expect probably this auction, the average should come in anywhere between 11 and 11.5%. There were with market intelligence, there were investors who came in at levels as low as 10.8, others as high as 12.5%. So we should expect it to come in about 11.5, which would be quite a dip from 14.9%, almost 500 basis points.
Now, talking about a dip there, we see Treasury bills hitting about a 10-year, about 10% at this stage. What is the market feeling like at this moment? They haven't really seen such rates over the past few weeks. Now, sitting at 10%, we have the CBR rate currently at 18%.
Actually, we haven't seen these rates in about 9 months, especially on the prime rates, the 91-day. Market, I should say, is a bit jittery. It feels like CBK has, in a way, changed goalposts. During the MLF meeting in February, they had been quite insistent that they're going to keep the rates in check, especially the prime rates and primary auction rates. They don't want it to shoot down too fast, which would just be as bad as the rates rising up too drastically. But I think they've actually not kept this in control. They have been reducing the amounts on offer, and but the subscription levels have not been rising at the same pace you'd expect to justify the rapid decline in the rate. We're seeing a few investors coming in, undercutting the market, and CBK is still taking up these funds despite them having met their domestic borrowing budget. So it's quite not so clear what way the rates are headed. These rates we're seeing of 10%, most market analysts are projecting these rates towards the beginning of the fourth quarter, actually the end of the third quarter. But we're here and it's midway through the year. So that does make the market quite jittery on which other direction we can go, especially if you look, for example, at the inflation rate. We expect the base rate effect that we've been seeing through the first half of the year to start weaning off towards the end of the third quarter. So, and a lot of factors, especially external pressures such as oil prices, are still existent. So the rates are, it's not quite such a definite that they'll shoot all the way down up to the end of the year. There is quite significant threats to the inflation rates and also to basically the interest rates in the market.
Let's talk a bit on the shilling at this stage. It continued to weaken. We saw it hit a 4-month low in yesterday's trading session. Would you say that the fundamental problems have not been corrected at this stage?
It would seem so, especially if you look at the reaction from the shilling in terms of whenever we see the amount of liquidity in the market rise, we'll always see an effect. We'll always feel an effect on the shilling, especially you could call it in a way, an excessive reaction from the market. I think the shilling now has crossed the 85 mark. Most of the day it was about 85.853. So that is that's quite scary. Although Treasury and Central Bank had indicated that they would be comfortable around levels of 85, and actually at the beginning of this quarter we had expected it to go up to about 85 shillings. We'll see the way they react as it goes. If it crosses the 86 level, they have been trying to mop up the liquidity. Although, for example, today they came into the market. Only about half of what they were looking for was taken up at about 17.6%.
Okay.
So the market is actually looking for longer lock-in periods. So it would be a problem mopping up liquidity going forward, especially also with the auction amounts having reduced.
All right, that's where we have to leave it. Thank you so much for joining us, Ken.